Hello, everyone. If you're new to the stock market, this video is a full tutorial. We'll show you step by step how to start investing in the stock market. Now, this isn't something we can learn in one day, but as you can probably tell, we're going to give you as much information as we can in this video. We're going to send you a pretty long video today. So I really want you to treat this like a class or a book and try to learn as much as you can. So I suggest getting a piece of paper and a pen, and feel free to stop at any time. You can put things on paper. We're going to give you a pretty long presentation about the basics of investing. As the video goes on, we'll go into more detail, and we'll try to keep things in order, but you're welcome to skip around. Maybe you know some of these things already. So you should go to the parts that interest you the most. I'll put timestamps down below in the description of this video so you can skip around. You can also check out some of the links and resources we have for different stock brokerages down below as well. So, I'm very happy that you're starting to invest, and we've had a lot of people ask for a video like this. In it, we go into more detail about how to actually invest in the stock market. People don't want to know how to invest in the stock market, they just want to know what to invest in. Most people usually work this way. So the fact that you're here watching this video shows that you want to learn how to do this instead of just listening to other people tell you what stocks to buy. I think this could be a really valuable asset that you can keep for a long time. So, before we get too far into this, I just want to say a few quick things. One of them is to be careful with scams, because there are people everywhere pretending to be me. They will probably try to get in touch with you. There are a lot of things like that. We don't have anything to sell you here. There's no course and nothing extra to buy. That's not something you need to worry about. I know it can be annoying when I'm halfway through a video and someone says, if you want to know everything about this, take my online course, read my book, or whatever. You can learn everything there is to know about investing for free at your local library or online. I think that's a great idea. Don't think that you need to pay someone to teach you how to do this. I didn't pay anyone a dime to teach me how to invest, and I think it's worked out pretty well. Also, I'm not a financial advisor, which is something else we should know. I'm just a guy who uses the internet to talk about things I've learned and done. I'm not trying to sound like some kind of stock guru when I say I'm the best investor ever. There's nothing that fits that description. I'm just a guy giving you some information, which I hope you find useful. If you do, please like the video and subscribe to the channel so you can see more videos like this. Let's start with the first point when talking about how to get started with the stock market. I'm going to go through this presentation now. I thought this was a much better idea than just having me talk on the whole screen. I'll just stand over here in the corner and talk you through this presentation. Like I said before, I really hope you're taking notes or at least taking screenshots or starting to remember some of the things we talk about in this video. So one of the first things we want to do is look at the difference between risk and return and try to make it bigger. So, what I mean is, how do we reduce risk? How can we reduce risk as much as possible while increasing the amount of money we could make? So, the goal should be to widen this gap so that risk goes down and potential returns go up. And sometimes I see people who might be going for investments with a high risk but a low return. So, you should always think about how much risk an investment has and how much money it could make. Now, let's take a quick look at some of the average stock market returns, so we can get a better idea of how this type of investment might stack up against others, like real estate, gold, or cryptocurrency. So, the average returns on the stock market over the past 90 years for the S&P 500 will explain what all of that means in the future. But over the last 90 years, it's been about 10% per year. Now, this information can be different for different stocks. But on average, the US stock market as a whole has grown by about 10% per year. Now, this doesn't take inflation into account. On average, inflation can be anywhere from 2% to 3% per year. Now, it's very important to keep in mind that these are returns from the past. This won't tell you anything about what will happen in the next 90 years. We really don't know, and we can see that the average stock market, when you add up all the stocks and look at the average growth or average decline, isn't very good. We have no idea what will happen in the future. But in general, since society tends to move forward, we probably won't see for a very long time. Most likely, the stock market will go up. But nothing here is certain, of course. So both of these charts can be seen here. The green and red numbers are the returns for each year. So some years, the stock market might go up by 30 or 40%, and other years, like 2008, the market might go down by about 40%. This is a pretty big drop, then. So it will change a lot. And you'll learn that investing requires you to have a thick skin. When we say this, we mean that sometimes you want to be able to keep your investments through a lot of rough times. Some of my friends sold a lot of their investments at the height of the pandemic last year, in April, when their stocks were down 40 or 50%. They were scared, so they sold, and now, a year later, they think, wow, I really probably should have just held through some of those rough times. So make a lot of trouble. The goal here, though, and what I'll talk about in this video, is how we can make sure we can sleep well at night. I sleep pretty well every night when I go to bed. I don't worry or stress out too much. And sometimes people worry too much about the stock market because they have too much debt, buy on credit, or do something risky that they probably shouldn't do. So, we're always going to try to reduce that risk. But I wanted to show you what the average returns are from the stock market. And of course, this is about the past. Now, let's talk about investing versus gambling. Now, this is similar to what we were just talking about when it comes to making investments. Our goal. My specific goal is to always make investment decisions based on logic and not on how I feel. And the most important question I ask myself before making an investment is, am I Nate? Am I investing or just taking a chance? I always asked this question right before I clicked the buy or sell button. I ask myself if I'm using logic or if I'm just going with my gut. Am I just going with my gut? Do I believe what someone told me? My friend sent me a direct message, DM, telling me to buy this stock right away. So I always ask myself, am I making an investment or am I gambling? There's a huge difference between the two, and I really want you to stop yourself right now, especially if you're just getting started with investing. Stop yourself and make sure you're making logical decisions, not emotional ones based on someone telling you that a stock might blow up and you'll make 3 times your money in 2 hours. Just be really, really careful. And the risks of going along with the crowd. I try not to follow the crowd as much as possible, because if everyone goes towards the same chance, we might all get stuck in a bubble. And this is what happened when the dot-com bubble happened. It's a really interesting bubble that happened in the late 1990s and early 2000s, when almost any company with .com at the end of its name saw its stock price double or triple in a matter of days because everyone was so excited about the internet. But this led to a huge stock market bubble in which stocks were way overvalued. So, we'll talk a bit more about that and the risks of bubbles and following the crowd in general. I just wanted to share that with you as an example of how we can control our feelings. Taking our time is the best way to do this. I don't like to make hasty decisions about money. And of course, when we talk about the markets in this video, you might not agree with everything we say, and that's totally fine. Some of this comes from what I think. Like, I think it can be pretty smart to not do what everyone else does. But you don't have to take everything I say here literally, and I think that shows that I'm not a total professional. I'm not telling you that this is the best way to put your money to work. There are many different ways to invest, and people have done well with all of them. Okay, so now we'll talk about what a stock is. And I'll read this out loud, and then we'll talk about it in more detail. So, a stock is a piece of a company that is traded on the stock market. So, when you buy stock in a company, you become a part owner of that company. So, if a company has 100 shares of stock and you buy one, you now own 1% of that company. One of my favorite things is this. As soon as you know what a stock is. I can still remember the first time I heard the word stock. I think it was a project in 1/6 or 1th/7th grade where we had to learn about the stock market. Once I found out that I could own a piece of $1 billion company and have a stake in it, I was hooked. It was one of the most exciting things I had ever learned. I remember when I was in 6th grade or maybe 7th grade, in 2009, going around saying, hey, I own a little bit of Google, a very small piece of Walmart, Waste Management, or Coca-Cola. And it was fun to think about being a part owner in one of these companies as I lay in bed at night. So, that's what a stock is all about. Stock exchanges are where they are bought and sold. We'll talk about some of the best stockbrokers and how to buy this specifically, but it's pretty easy to buy and sell now. All of this comes down to supply and demand. So, if I have shares of stock and you want to buy shares of stock, I can sell those shares to you through a stockbroker. As I said, we'll talk more about stockbrokers in a few minutes. For now, though, we need to know why companies issue stock and why this has to happen. Why does this have to happen? So that they can raise money. So, a company can get money by giving out shares. You may have heard of IPOs. I know that Coinbase just got a new listing and made a lot of money from it. Because of their IPO, a lot of money has poured into Coinbase. This also happened to a lot of other businesses. So, most of the time, companies sell stock to raise money. But let's look at how stocks and bonds are different. You probably hear people talking about bonds. In 2021, bonds aren't very appealing because they don't pay off much. Things could change. It most certainly did. It's very different from what it was like in the 1980s and 1990s. But with stocks, unlike bonds, you actually own a piece of a company. You get a share of the company's revenue and profit because you own a piece of that company. But if you buy bonds from a company, you don't own that company. Instead, you're just lending the company money, and the company pays you back, maybe with a little extra. So, that's what makes stocks different from bonds. I hope I was able to explain that, and if you have any questions along the way, please let me know. And you're not sure what to do? Feel free to leave comments below, and I'll try to answer them if I can. Just watch out for scammers, because there are a lot of them in the comments. You can also send me a direct message, DM, on Instagram. I'll do my best to answer, but I do get busy sometimes, so I hope you'll understand. Now that we know what a stock is, we can say that it is just a very small piece of a company that you own. We'll talk about how to buy stocks next. So, you can buy stocks in a lot of different ways. If we look at history, we go back a long way. You would have to find a way to talk to the company and buy the stock if you wanted to buy a stock. You might have to go to your bank through a stockbroker. We're talking about a long time ago, like 100 years ago. Back then, it wasn't easy to buy stocks. Then we started to see that you were on the phone with your stockbroker. And if you think of a movie like The Wolf of Wall Street with people talking to their stockbrokers on the phone, that's how it was for a long time. If you wanted to buy stocks, you would call your stockbroker, and they would handle the transaction for you. They would buy it and sell it for you right now. We've moved into the digital age, and around the middle of the 2000s, there was a big increase in online stock brokerage firms. Now, you don't have to talk to a broker to buy or sell stocks, you can just click a button or press a button on your phone. Now, let's talk about some of the best US. We'll talk about brokerage firms and then about some of the best ones in Europe. Don't be afraid. I know I have a lot of friends in Europe, but I won't forget about Asia, Australia, and Canada either. It really depends on what country you're in, and I don't know who the best brokers are in every country, but I can give you some good ideas of brokers you can use to buy and sell stocks. So, if you're in the US, here are 3 I'd recommend. You can choose from these 3, and I'll leave links to each one below so you can check them out and decide which one you want. You can also open multiple accounts and try them out to see which one you think is the best place to buy and sell stocks. The first character would be like Robinhood. Even though it's one of the most common, it's not my favorite. So I thought it should be on this list. Then there's Public, which is a lot like Robinhood in many ways, but it also has a social feature, so you can see what I'm buying and selling on that app on Public. After that, M1 Finance is also one of my favorite apps for making money. And M1 Finance is a great place to put money away for the long term. For example, if you want to start a Roth IRA and use it for long-term investments, M1 Finance is usually the place I go for that. So, out of these 3, which one do I like best? This depends a lot on the deals they're running. So, sometimes they'll give you a free stock or something else for free. If they do, I'll put that link down below, too. It has some of the best features and options you can get right now. Here in 2021, I'm making this video. I don't know if things are going to change, but if they do, I'll link to the best broker because sometimes companies have problems. So, I'll keep that as up to date as possible. Now, let's talk about what to do if you want to invest in the stock market but don't want to think about what you're buying. You just want to set it and forget it. If you want to do this in a passive way, you could use Wealthfront. So when you use Wealthfront, you don't buy and sell individual stocks. Instead, you buy and sell mutual funds and ETFs and investments for the long term. And you just tell them that you want to be risky or not risky, and you can give them a few different options for when you plan to retire. There are a few choices like that. Wealthfront can then help you invest your money. They charge a very small amount. So, I also put a link to them below. They are a great business. I've been working with them for a long time. And so, Wealthfront is another way to invest passively for the long term. Then the other three: Robinhood Public and One Finance. But there are also other options, like Weibo and some others that we won't have time to talk about in this video. So I hope I can also write a review of some of my favorite apps for investing. If I don't forget, I'll do that. Then I think that would be good for you. I was talking about the best brokers in the world. What should you use if you are not in the United States? Here's the short version: Toro. It's not bad at all. I like it. Toro, and it can be bought in a lot of places. So, if you live outside of the United States and want to start investing, I would suggest something like Toro. They also have a lot of crypto investments in some places. So make sure you read the fine print to find out what you can get and what you can't get in your region or country. It's pretty nice, though. There are also something like trading 2-on-2 seems to be a great idea in Canada if you live in the UK. A lot of people we know use Quest Trade. There are also some great ones in Australia that I will link to. On top of that, there are some others like Zero and Revolution and a few others in Europe. So you know what? I'll make another video about apps for investing in Europe. And for some of the other people around the world, I know this is one of the most common questions I get, and you can probably find the answer by doing a Google search. But I promise that at some point this month, I'll make a video just for all of my international friends who want to start investing and want to know which brokerage firm they should use if it's not in the description below. So that's what we'll do about it. So, those are the best brokers you can work with. Now let's talk about the different kinds of brokerage accounts. There are individual accounts, joint accounts, accounts for retirement like IRAs, and custodial accounts. So a personal account is probably the easiest one to set up. It's the one you can use if you just want to buy and sell stocks. A personal account is pretty easy to set up. Then there are shared accounts. For example, if you have a spouse and you want to open an account with someone else, you can do that with a joint account. Now we have retirement accounts like IRAs. If you're going to sign up for an IRA and want to save some money for retirement, I'd suggest using M1 Finance or Wealthfront. I'll put links to both of them down below. But both of those are great businesses. set up an IRA, or a Roth IRA as a requirement. We do have videos about those things, too. If you don't know what an IRA is, it's an individual retirement account. I do recommend having one, but I'm not a financial advisor, I'm just a guy on the internet. We also have custodial accounts, which are great for people under the age of 18, because if you're under the age of 18, you can't sign up for brokerage accounts, Robinhood accounts, or public funds. You can't sign up for them on your own, someone 18 or older has to do it with you and make a custodial account. This is how I began investing when I was young. I talked to my parents about the stock market, and they didn't really know much about it, but I learned about it in school. It was very interesting to me. I was a strange child. I don't know, I guess I just liked to read, so I was interested. I had them help me set up an account, so technically it was my father's name on the account. So, this isn't legal advice, and I can't tell you that if you're under 18, your parents will have to do it for you. However, you can talk to them about it, and they can make the trades and transactions for you. I used to do that when I was younger. So those are the different kinds of brokerage accounts. If you're not in the US, you might also see some other choices. I don't know the laws in your country, so I'm not sure if I can help you with that. Where you are, they are definitely different. Okay, let's talk about how to invest now. At the moment, there are 4 main ways to invest. Some people will argue that there are only 3, but I'll talk about all 4 here so you can get a better idea of what each one is and how it works. So we have fundamental analysis, technical analysis, behavioral analysis, and dollar cost averaging. Each of these has pros and cons, and we'll talk about them all so you can decide what kind of investor you want to be. This question is very important. You should ask yourself, what kind of investor do I want to be? What do I want to do? Do I want growth in the short term? Do I want to make $1 million in one day? It's probably very unlikely. Or do I want growth in the long run? Maybe 10 to 30 years, so I can be ready to retire. And my family said I won't have to worry about how to pay my bills when I'm older. So you should think about how you want to invest, and you can find out more about it. This could be done through a number of books, some of which we'll talk about later in this video. But let's talk about the most common one, which is called fundamental analysis. Value investors also use this a lot, and when I think of value investors or fundamental analysis, I think of this guy right here, Warren Buffett. I think he's almost 90 years old at this point. Even though he is getting on in years, he is one of the best value investors of all time. And he uses fundamental analysis to figure out whether a stock is overpriced or underpriced. And this is what investing is all about. We want to find investments that other people might have missed. And we want to put money into businesses. We're looking for stocks that aren't worth as much as they should be. So we're comparing what they're really worth. We're looking at the basics, like the balance sheet, income statement, and cash flow statement, to figure out what we think their real value should be. We look at the basics of a company and its health to decide if its stock is undervalued or overvalued. And there are a lot of different ways to figure this out. But this is what this video will be mostly about. We would like to use basic analysis. I would recommend it, or at least learning how to do fundamental analysis on companies, because that's how you'll figure out if a company is healthy or not. I use a lot of these ratios and other financial metrics. It's like when you go to the doctor and they check your heart rate, blood pressure, temperature, and other important vitals. We do something similar with fundamental analysis. We're trying to figure out what a company's blood pressure is and what its temperature is. So, we're looking at how well the company is doing. And that's just a little comparison that might help you see what I mean. But most of the time, fundamental analysis is used to look at the long term, which is especially true when value investing. So, that's the one we'll talk about in this video, and we'll go into more detail in the second half. Now, there is a second strategy called technical analysis. Now, when you think of a stock trader, you might think of someone with 5 big monitors, charts everywhere, and red and green bars showing that they are trading stocks. This is what you might call technical analysis. They sometimes trade in penny stocks and do a lot of swing trading. But most of the time, people use technical analysis when they want to make short-term trades instead of long-term investments. And this doesn't always happen, but it usually does. I would still advise you to learn about technical analysis, because it can help you invest in certain things at the right time. So I do look at the technicals of stocks and the charts. I think that 51 would be a good time to get into that position or stock. But in general, I don't spend much time on technical analysis because I'm more interested in long-term investments. If you are a day trader or a swing trader, technical analysis can take up a lot of your time. I don't have anything against day trading, and I have a lot of friends who make money doing it, but I see a few problems with it, the biggest of which is that it tends to take up a lot of time. You can't just go to sleep and your money will grow. You have to really look at these charts and think about what they mean. So it's not really my thing, but if it's yours, that's awesome. Just be careful of the many people who sell their courses on technical analysis and stock trading online. You don't have to do that somewhere. You can get some books or watch 3 videos to learn more about how to read stock charts. Now let's talk about analyzing behavior and how to use social cues. This is my favorite way to figure out whether I should buy or sell a stock, and behavioral analysis is a fairly new method. But what we're doing here is looking at human psychology, and we were thinking about groupthink in financial markets. So, the markets are filled with a lot of cognitive bias. So, we're making the assumption that there are a lot of people who don't act rationally. We might think that the market isn't going to be completely efficient, and that not everything is priced in, but people might act out of fear. Yes, this does happen. Look at how many times the market has fallen. We've seen stocks go down 80 or 90% because people were scared for no reason other than the fact that humans are very emotional creatures. We can make money if we can understand and really separate logic and emotion, and if we're able to put those two things on opposite sides of the spectrum. A lot of the time, behavioral analysis can really help with this. And I'll give you an example of a stock I bought using social signals. It was Spirit Airlines, which is a very cheap airline that a lot of people make fun of. But I bought this back in October, and since then, it has more than doubled. I'm sure I've also made some bad investments. But I used a lot of social cues and analysis of how people act to make this investment, and decide that it would be a good one for me. So, we'll talk about social signals when we talk about how to find winning stocks, which should be in about 20 minutes. We'll talk about how we use those social signals now. There is also dollar cost averaging, which is the fourth way to invest. And this does have some good points and a couple of small bad points. But I think it's the one that most people use when they invest in the stock market. Now, with dollar cost averaging, you even out short-term volatility by putting money into the markets or maybe just one stock, but usually a lot of money into large groups of stocks, such as index funds, mutual funds, or ETF. People do this by putting money into the market every once in a while, maybe once a month or every 2 weeks. They do this so that they can spread out how much money they put into the markets. So, the great thing about dollar cost averaging is that if you do it, you put money into the market, say, once a month, when you get paid. Well, maybe if there was a big one at the top and you were doing this, and then it went down while you were still putting money in the whole time. Now, if you weren't using dollar cost averaging. Let's say you had $1 million because you just got it as an inheritance. That's great, right? Let's say you take that $1 million and spend it. And you don't dollar cost average, you just dump it all into the stock market on one day, which happens to be August 29, 1929. Then, over the next 3 years, because you put the money in at the wrong time, it turns into $80,000. So averaging helps make things more even. Because of this, many people do like it. I'd say that the best thing about this is that it's usually a pretty passive investment. This means that you'll probably sleep well at night knowing that markets tend to go up over a long period of time. Still, that's not a promise. Just keep in mind that it isn't a promise. In the market, anything can happen. People often say that the best way to time the market is to spend time in it. So, this is also one of my favorite quotes to help me remember how hard it is to really know when to invest. The only problem with the passive investment strategy of dollar cost averaging is that you might miss out on some chances to buy. I can still remember March of 2020. If I only did dollar cost averaging, I wouldn't have put in much money after the markets dropped 40%. I saw a lot of investments I could make. So, if I were only doing dollar cost averaging, I would play it safe and only put in a couple of $1,000. But instead, I thought this was a bit of a chance. So I put a lot of money into it. It worked out pretty well for me in the end. So one of the only bad things is that you might miss out on some opportunities when stocks have dropped a lot, and people are panicking and you're running away from that. One of my other favorite Warren Buffett quotes is, "Be afraid when other people are greedy and greedy when other people are afraid." So, when everyone is running away or getting scared, it might be a good time to buy. Not all the time, but sometimes. So you need to find out more about that. So, those are the 4 ways to invest your money. There are 4 types of analysis: fundamental, technical, behavioral, and dollar cost averaging. Hope you wrote those 4 down, because you might want to use more than one of them. I use a combination of all 4 of these all the time. And I was just learning about each of these and how you might use each of them when making investment choices. Let's talk about the difference between active and passive investing. Just now, we talked about dollar cost averaging. So, let's talk about what's good and bad about each of these. First of all, there's active investing, which is the way I spend most of my money. This is research, and this is figuring out what the risks are. You want to do better than the stock market. You think you know more than the stock market, or that you can find better ways to invest your money than just putting it all in a big index fund that follows the stock market as a whole. So that's what it means to invest actively. The problems with investing on your own. It takes a long time to do. I spend at least 10 to 20 hours a week looking at the stocks I own and making sure everything is running smoothly. I do this by reading a lot of their financial statements and looking at the news about those companies. This helps me make decisions and steer my ship of money, which isn't that big, but maybe my small boat of money, and I'm trying to steer it in the right direction. And with active investing, you know, it could be a problem if there are rocks everywhere and you're trying to steer your little boat while making sure you're managing your money well. So it might be pretty dangerous. If you invest actively, you might lose a lot of money, but I think you learn a lot over time. And you could potentially be the stock market now. Passive investing, you're probably using some type of dollar cost averaging. This is usually done with different types of assets and for fun to reduce risk. So you can put them in index funds, mutual funds, or ETF. This could have 500 stocks, 1,000 stocks, 23,000 stocks, or even 4,000 stocks. This is where you are putting your money. And it kind of spreads out among all of those different stocks. People do this because dollar cost averaging into a lot of different companies is thought to be a pretty safe way to invest. Because let's say that one of the 500 companies in which you invest goes out of business. Well, you still have the other 499 businesses to keep growing or at least stay in business. So that's kind of the point, as opposed to active investing, where you might only own 5 stocks. One of these businesses goes out of business. Maybe your investment portfolio just went down by 20 or 30% because you had too much money in one company. Okay, so these are the three most important indexes in the United States: the Dow Jones Industrial Average, the S&P 500 Index, and the Nasdaq. I'm sure you've heard these terms before, like when someone says that the markets are down 300 points today or that the S&P fell 4% today. So, if you've heard these terms or people talking about this, whether you're walking down the street and someone says it, or you're at Thanksgiving or Christmas dinner and someone goes on and on about how the markets are up 1,000 points or something is down, you've heard these terms or people talking about this. Most of the time, they will be talking about one of these three indexes when they say that. Now, these indexes are great for getting an idea of how the stock market as a whole is doing. So, let's start with the Dow Jones. Now, this list has about 30 companies on it. These are all very large companies in the US. Many of these stocks are called blue chip stocks. So it's a lot of companies that you probably know, and if you want to know exactly which companies are in the Dow Jones, all you have to do is do a quick Google search. But the Dow Jones isn't a single stock or a single company. It's just a way to see how the stock market as a whole is doing. So it's not a real thing, but more like something you made up in your mind. It's just a way to measure how well stocks are doing. So, that leaves us with the S&P 500 index, which includes 500 US companies. These are also very big US companies. I know that Tesla just joined the S&P 500. So, there are many different businesses in this. But I think this is the best way to figure out how the stock market is doing. So, if someone asked me how stocks have done over the past year, I would use the S&P 500 as a point of reference. I would think it was good if the S&P 500 index went up 20% last year, it's probably safe to say that the stock market as a whole went up about 20%. So it's likely one of the best ways to see how the US economy is doing. Every day and over a long period of time, the stock market is doing well. We now have Nasdaq. The Nasdaq tends to have a lot of tech companies, like Apple or Google. The Nasdaq was very popular during the dot-com bubble in the late 1990s and early 2000s, when many companies were called dot-coms. When you think of the Nasdaq, you probably think of a lot of tech companies, internet companies, or software companies. Now, let's look at the 11 most important parts of the stock market. I think you should really focus on just a few sectors, and we'll talk about how to find stocks, especially how to find good companies. But here's what I would do: the stock market has 11 different main sectors. I would put most of my attention on the ones you may already know a lot about. You may have a lot of things you like to do. Something like finances, or maybe you're really into real estate or telecommunications, IT, real estate and telecommunications. Right? We have a lot of different ones here, including energy materials, industrials, consumer discretionary consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and real estate. So I'd suggest putting most of your attention on a few of these 11. Don't try to be an expert on everything going on in the US economy. That is going to be very hard to do. So I tend to pay attention to just a couple of them. So, when people look at something like energy, they might think that there are a lot of solar companies or windmills. In reality, though, a lot of energy comes from regular companies like ExxonMobil, British Petroleum, and Shell. So, all of these will be very different, but each industry will have its own standards for what makes a good or bad financial ratio or metric. This is what the next section is about. When we talk about how to find good stocks and winners, I want to say a few words about mutual funds, exchange-traded funds, and index funds. How do they differ? The good news is that it won't be the end of the world if you use one of these three words in place of another. They are a lot alike, but there are still some differences you should know about. Now, most mutual funds are managed by people who do something. They tend to have a bit higher fees than something like an ETF, which stands for Exchange Traded Fund. Stands for I don't put much money into mutual funds, either. They also don't get updated until the end of the day, while an exchange-traded fund will get updated at the same time at any time. So it will be constantly updated all day as different ETFs are bought and sold. So ETF tends to follow index funds, which means you can buy an ETF. You can buy an ETF of something like the S&P 500. You can buy an exchange-traded fund, ETF, of the Dow or the Nasdaq. So it's a great way to put money into the stock market as a whole. If you wanted to say, hey, I'm going to put my money in the S&P 500, which will have a lot of different stocks in it because I want to be safe. Maybe I want to do this without much thought. I don't want to have to think about what to do with my money and then put it into a S. And the S&P 500 index, which is going to be an ETF. You can do this because it doesn't cost much. That only needs one ticker. As an example, let's look at VOO. So if you just type VOO, you could find this index fund, which is going to be an ETF, in your stockbroker's jump. That would fall into that group. So I hope I didn't just make that even harder to understand. But I usually like exchange-traded funds the best. Like to put money in mutual funds. You'll need a little bit more money to get into them. This makes the barrier a little bit higher. To buy into a mutual fund, you may need $1,000 or $3,000. So, in general, I do like ETFs, which are very similar to index funds. Even so, you could also have mutual funds that act like index funds. I hope I'm not making that more hard to understand. If you want to know more about mutual funds versus ETF, you can do a quick Google search. Let's talk about how to find stocks that will do well. We're going to get into a lot of specifics here. We'll talk about a lot of different financial metrics, ratios, income statements, and balance sheets. It's going to get very in-depth. So I really want you to write this down or stop the video so you can really think about it as we go through this video. How do we find stocks that will do well? From my point of view, this is how I find good stocks. Different people will have different plans. Someone might tell you to do something different, which is fine. So you don't need to follow this advice. This is just what I do because I'm not a financial advisor, which has been said several times in this video. How do I find stocks that will do well? I like to think about things that I already know and understand. I think this is a great place to start for someone who wants to start investing. So, here's what I think you should do: get a pen and a piece of paper, and write down 5 of your interests or 5 things you think you know more about than the average person. Maybe you love cars and know a lot about them. If you know everything there is to know about the car market, you could write that down as one of your strengths, something you may know more about than the average person. If I had to do that when I first started investing, I would have looked at a lot of agricultural companies because, believe it or not, I did a lot of agricultural work and liked farming, so I knew a lot about the different ag companies out there. So, that was one of my strong points because I knew more about that business than most people. You can actually make this for yourself, though. If you're sitting there thinking you don't know anything about any industry or sector, you don't have any hobbies, and you're not good at anything, which I'm sure you are, then you're wrong. Trust me, you are. But if you're sitting there thinking you're not good at anything, pick a couple of different categories and say, I'm going to learn a lot about amusement parks, or I'm going to learn a lot about the soft drink industry, or I'm going to learn a lot about the camera industry. And so you can start to learn more about those, but focus on what you know, and people on specific industries, specific topics, so that you're not just trying to be a jack of all trades, because if you're trying to be a jack of all trades and you're going over here and you're looking at the swimming pool industry, and then you're looking at home builders, and then you're looking over at some new technology companies, and you're looking at crypto companies, you're going. I try not to do that and instead try to focus on what I'm doing. I also do my best to block out outside voices or hype. Look, if you're on Discord forums, you're on TikTok, and you're getting stock investment advice from TikTok. Be careful with that because a lot of people have their own goals, even if you're just looking up a company on Google, like if you want to buy Coca-Cola stock. So you Google Coca-Cola stock, and maybe you find an article that says this stock is definitely a great company, and you should buy it, etc. This is why I'm going to buy it. Okay, it's good to read that and what they have to say under and under. But keep in mind that everyone probably has their own goals. And the person who wrote that article about how great Coca-Cola stock is might have a lot of it and want the price to go up. So just keep in mind that everyone may have their own goals, so when you invest, focus on yourself and your money and try to shut out as many outside voices as you can. That's going to be a very important step, because if you just follow everyone else and get in at the top of a bubble, like if you buy Tesla at tens of thousands of dollars and maybe it's in a bubble, I don't know, you can lose a lot of money because everyone is hyped up and excited about it and you're just going with the flow. Now, here's how I find winning stocks. I look at the big picture first, then I look at the details. So, look at the bigger picture. This is how I found a company like Spirit Airlines back in the fall, when COVID was still spreading and there was no vaccine. There were a lot of problems, and airline stocks went down a lot from the year before. So, I looked at the overall trends in the airline business. So, I looked at the big picture. When we talk about macro versus micro, I was thinking about the big picture. This word means big picture. Right? So, when you think of macroeconomics, think of the whole economy and big industries. And then micro looks, kind of like with a microscope, at the details of a certain company. So, when looking for macro trends, one of them was, hey, you know what? It's the fall of 2020 when I had this thought. You know what? I think airlines have a really bright future. Since people couldn't fly in 2020, there will be a lot of pent-up demand for airlines in 2021. Obviously, the pandemic has caused a lot of problems. So, I was looking at a big picture trend that said there will be a huge increase in the number of people who want to fly. So, once I saw the big picture, I said, now I need to look at the details. So I think the airline business is probably ready to go. In a couple of years, it'll be doing well. So, let me now look at the micro and find 5 different companies in the airline business that I can analyze. This is called a top-down strategy because you start with the big picture. Then you look at individual companies. You can also work from the bottom up. This isn't as common, but maybe you're analyzing one company. Let's say you start with one company, like Peloton stock, because you're interested in buying it. You then look at Peloton stock and decide that it has good fundamentals. Then you can look at its competitors and the industry as a whole. You can start small and get bigger, but I would rather start big and then get smaller. We hope that doesn't make you confused. But this is how I find stocks that do well. That's how I find 3 to 5 companies in a certain industry that I might be interested in. I'll do a deep dive into 3 to 5 of these companies. I'm spending a lot of time per company reading all of their financials and analyzing the business. Then, out of these 3 to 5 companies, I'll probably only invest in 1 to 2 of them, or sometimes none of them. But usually, I'll only invest in 1 to 2 of the 3 to 5 companies I choose to analyze in a certain industry. So that's one way I'd suggest finding stocks that are likely to do well. But how do we get the information we need? How do we judge this business? This is what we're going to do right now. So the first thing we do is stop analyst reports from getting through. As I said on the last slide, analyst reports should be ignored. Most of the time, they have a plan. Usually, someone hires them. I see this all the time. An analyst says, you know, this stock is definitely going to go up 20 or 30% by the end of the next quarter. And then you start to look into it and you find out that, the person who wrote the article has some kind of connection with someone at that company. And, in my opinion, it's all just a big scam. So I wouldn't put too much stock in what analysts say. You can read them because they might have information that will help you if you want to buy or sell a stock. But try to ignore some of it, or at least, don't take it too literally. Now. Also, where can you learn things? You can get it from the research features of your brokerage. So if you use Robinhood, Public, TD Ameritrade, or any other brokerage firm, you need to do this. This is an excellent way to find stocks. Check out their graphs. You can look at some of the basics and maybe find some of their financials on those pages, but it's not the best way to find stocks if you have a brokerage research tab. The investor relations page of a company is by far the best place to learn about a stock in the company as a whole. So, I'll talk about a company as an example. So, let's take Spirit Airlines as an example. We'll look at their investor relations page and learn more about it. This is the best way to find out about something. The easiest way to do this is to type investor relations and the name of the company you're interested in into Google. So, we'll just type in Spirit Airlines investor relations, and then we should be able to find their investors page. They will have annual reports, which are also called Form 10-K. They will also have 10-Qs, which are the company's quarterly reports. Now, most annual reports can be hundreds of pages long, and some can be as long as 200 or 300 pages. It's pretty much a book about everything about that company, including some of their issues, problems, and things they think will be good for the company. So make sure you read that it will be free to download, and that it will most likely be in PDF format. Somewhere on their page about investors. This will be listed as Form 10-K, or last year's annual report. And reading this will be the most important part of any investment you make. You can also check CNBC, MarketWatch, or Yahoo Finance for news. I think I probably like CNBC more than these. But even if you watch CNBC, if you put too much stock in the news, you'll notice something every other day. CNBC says a different thing. For example, on Friday they might say that the stock market is going to the moon, and on Saturday they might write about how the market is going to crash the next day. So they kind of change their minds because, they're just a news company. So they want to make money, and they do so by getting people to click. So you shouldn't take that either. But I do like to watch CNBC to see what's going on. They sometimes watch it, as well as the closing bell and a few other things. If you have a TV, you could watch some CNBC to get a better idea of what's going on in the markets and make sure you're at least up to date on the news. And also books about making money. I'm going to leave you a lot of books about investing to read. You can find these books at your local library or buy them on Amazon for $10 or $15. Benjamin Graham, who is known as the father of value investing, wrote one of my favorites. It's called The Intelligent Investor. He was one of the best investors ever. Also, get some books on investing, because this isn't something you can learn in a day. This isn't something we're going to watch a 2-hour video on and be experts at. It's going to take time, and there are 2 ways to really learn how to invest in the stock market: by reading books and watching videos like this, and by doing it. I want you to remember that last one, because experience isn't something you can get quickly. It's going to take time. It takes up a lot of time. So the best way to learn is to do both. So that's how we find out things, then. You can also gather from 2 in other places. There are also a lot of other sites you can use to find information. Let's talk about the financial statements now. There are 3 important financial statements that we can use to look at the basics of a company. The balance sheet is here. We have a statement of income and a statement of cash flows, also called a cash flow statement. Each of these will tell us a lot about the company. We can start to peel back the layers and start to look at the basics. How much does this company make? How much cash is being brought in? How much cash is leaving? How many skills does this company have that are the same? How much debt do they have? Do they owe money to a lot of people? If you've taken an accounting class, do they owe you a lot of money? If you took any kind of accounting class in college or even high school, this will be a lot easier to understand. I took a lot of accounting in college, so it was easy for me to understand. So, if you want to learn more about how these things work, you might also want to read a book about accounting. But I don't think these are all that hard to understand. At first, it might look a little like hieroglyphics, but once you learn the basics, you'll be able to translate it and use it. Use that knowledge for a very long time. So, we're going to start looking at financial ratios and metrics. First, let's talk about some of the measurements you'll see. This is just a screenshot of Spirit Airlines from CNBC, and this is a lot of what you're going to see underneath it. So, we're going to break down each of these key statistics, and then we'll talk about ratios and profits. For now, though, we just want to go over a few key statistics. Some of it might seem obvious, and some of it might look a bit strange. Now, we'll point out each of these. Here are the facts. We have the open, the day, the high and low for the day, and the previous close. These should be easy to understand. The price is just this. So, Spirit Airlines started trading at $35.51 and reached a high of $37.12 at some point during today's trading day, which runs from 9:30 a.m. to 4:30 p.m. to 4 p.m. Eastern Time, but you should know that different markets have different times. So it will be different if you're in California. If you go to London, things will be different. So you should also look into that. The day low comes next. So the bottom was at $34.40, And yesterday it closed at $36.01. So those are the important numbers for that. Then we have the average number of shares that change hands in 10 days, which is 2.84 million. So, we can see that, on average, 2.84 million shares are traded every 10 days, and there are 97.81 million shares in circulation. This gives you a sense of how volatile things are and how much they are changing. Is there a lot of stock that needs to be moved? Do a lot of people buy things right now? Do they have a lot of sales right now? When you look at the average number of shares bought or sold over the past 10 days, you can get a sense of how volatile the market is. We have the 52-week high, 52-week high date, 52-week low and the low date for that. So this just helps us kind of understand the range of where the stock has been in the past year. We can also use the stock chart for this. So I don't really spend a lot of time looking at this, but let's look at the 52-week low, was $7.25. And that was back in May of 2020 when it was really low because of the pandemic. So now it's gone up fivefold or so since then, at least fourfold. But anyway, those are just some of the basic metrics that we can use. Then we have beta. Beta is a nice little thing that we can look at, which is going to help understand a little bit about volatility of this specific stock. But if you want to learn how to calculate beta, it's pretty simple. What we're doing here is we are comparing the stock price, how much it's fluctuating in comparison to the overall stock market, which is going to be the S&P 500 in most cases. So we are comparing the volatility of this stock of Spirit Airlines stock, comparing that with the volatility of the overall stock market. And that's going to help determine what the beta is of the stock. Now, let's simplify this and make it easy for you to understand. A beta of 1 is going to be what the stock market is in terms of volatility of how much it goes up and down. Is it going crazy swings? Is it shooting up 50% and then dropping down 80% the next day and then shooting up 100% the next day? So those are the questions that we have with beta, and this helps us determine how volatile stock is. So with the beta of 1.74, it means that Spirit Airlines stock moves more dramatically than something like the overall stock market. If the beta was below 1, it would move less on average than the overall stock market. So hopefully you see kind of how that can be used. A beta of 1 is average, above 1 is going to be a little bit more volatile, maybe more choppy. Bigger swings of up or down could be either way. And a beta below 1 is going to be more stable. So something like cash would have a beta of extremely low because it wouldn't really move at all. Right, so that's how we make that determination for beta. You can go ahead, check out that video if you really want to get into how to calculate beta, but usually you can just see it presented there for you. Now we have market cap. The market cap is going to be a simple calculation. This is market capitalization. I love looking at this because this is kind of the overall value of the company. So as a whole, Spirit Airlines is worth $3.62 billion. And how we determine the market capitalization? It's a very simple calculation. We look at the shares outstanding, the total amount of shares of stock, which is 97.81 million. And we multiply that by the stock price, which is about $35 or $36. So we take 36 multiplied by 96.7 million. And that's going to give us the market cap or the market capitalization of $3.62 billion. So that's how we come up with that number there. And then we also have the year-to-date change, which is going to be pretty self-explanatory as well. Remember this from like high school math. Probably it was just new minus old divided by old. It's going to give you the percent change of a stock. Alright. And now we can talk about all of these different ratios and profitability. So let's get into these here. I really do suggest writing these down. We're going to give you the basic understandings of each one of these, but we could probably spend 2 to 3 hours on each one of these ratios and the benefits of it and how to use it. So we're probably not gonna spend a couple of hours per, we're probably just going to, focus on maybe 5 to 10 minutes on each one to give you the basics of it. And then I would highly urge you to go and do deeper research on each one of these ratios, because this is how we actually determine the well-being of a company and determining whether we're gonna buy this. So let's start off with the first one here, which is earnings per share. It's a very basic calculation. We're just taking that income subtract preferred dividends, and then we're looking at the common shares outstanding at the end of the period. Might sound kind of confusing, but when you actually start to look at it, it's really not terribly confusing on how to calculate earnings per share, luckily. Also, this is usually information that you can just see by Googling it or finding it within this company's information on their investor relations page on what their earnings per share is. So you don't have to do a lot of these calculations, they're already done for you. But this is going to be an indicator of this company's profitability. So how much are they earning per share? And so in a higher earnings per share tends to show greater value. This isn't always the case. So sometimes that the earnings per share is really high. That could also be some red flags, as you'll notice with a lot of these different financial ratios. So you really want to focus on earnings per share growth. And this is something that I'm always looking at historically over the past quarters, over the past years, how has earnings per share? It hasn't been growing, has been declining. This is something that you're really gonna want to pay attention to very closely. Now talk about the price to earnings ratio, the P/E ratio. It's probably, I would argue, to be the most common ratio that people talk about when they refer to stocks being undervalued or overvalued. Now this helps gauge the valuation of a company. So a high P/E ratio is going to show that there's a lot of growth anticipated for this company. And I'll give you examples of this in the next slide. We'll compare Tesla versus General Motors to companies that are in the same industry. They're both in the car industry, but they have very different pay ratios, price to earnings ratios. A low P is generally seen as having lower growth anticipated. And so as you can see here, you want to find companies that have a lower P/E ratio. But you think should have a higher P/E ratio. Now, hopefully that makes sense that what we're saying, because you want to find companies that don't have a ton of growth anticipated. But really there is gonna be a lot of growth. Right? That makes sense. So a P/E ratio of 15 would mean that the current market value of the company is equal to about 15 times its annual earnings. This is a really simple calculation. You just take share price and divide it by earnings per share. So how do these two stack up here when we're looking at P/E? And how can we actually use this? Let's make sense of it here. So we have Tesla stock and we have General Motors stock. Now the P/E ratio here, you'll see TM. This means trailing 12 months, and then you also see the forward P/E, which is NTM, which is the next 12 months. Little terminology there that you might want to write down. But let's look at Tesla stock P/E ratio compared to General Motors stock P/E ratio. Now the trailing 12 months P/E ratio here is 1225.999 for Tesla stock. Now I'm gonna give you a little tip here that the overall P/E ratio of the average stock market tends to be roughly in the teens, sometimes in the 20s. I think right now it's in the 30s. So the average company's P/E ratio is about 30 something right now. This fluctuates based off of, you know, where the stock market is. Are we in a bull market, bear market? But a P/E ratio of 1225 is a lot. And this doesn't mean necessarily that the company is overvalued. It just means that there is a ton of growth expected for Tesla stock. And if Tesla doesn't have that massive boom, if Tesla doesn't sell a ton of cars, if they don't have this massive growth and actual revenue and sales and profits, then it might be a problem. And I'm not saying that Tesla is a good buy or a bad buy. I'm just pointing out here that a higher P/E ratio is going to show there's a lot more growth anticipated for Tesla compared to General Motors. Now, most people think of General Motors and you know, it's GM. Right, they're not this revolutionary company right now at the moment. They don't have tons of electric cars, they don't have all these things that Tesla has. And so their growth is a lot lower in terms of anticipation. So people aren't expecting General Motors to grow a lot, and that's why their P/E ratio is 13.53. So the goal here with P/E ratios is to try to find those companies that have a lower P/E ratio, but also you think should have a higher one. You think it should be higher because they should be able to, you know, really perform well. So that's kind of the balance there, but overall P/E ratio, it's not just one thing that you can look at and say this is undervalued or overvalued. You can't do that. It's just a basic ratio, and there's so many different ratios that we need to take into account to determine whether or not a company is undervalued or overvalued, because both of these here, Tesla and General Motors, I really can't tell you just based off of this information that we're looking at here. I can't tell you which stock is going to perform better over a period of time because we don't have all the information yet. Alright, so now we have the price earnings to growth ratio. This I like to use a lot more than just the general generic pay ratio because we're also factoring in expected earnings growth into this calculation. There are some problems with this. So one of those problems being that this is going to be dependent on what you think the earnings growth is going to be. You have to make some projections, you have to extrapolate a little bit on the data and try to make some assumptions. So that's the problem with this price earnings to growth ratio. But I do like to definitely use this, it's a pretty simple calculation. It's price divided by earnings per share and then you're dividing all of that by earnings per share growth that you're getting away. A lot of people like to target this ratio below 1. Although of course, you know, it might fluctuate dependent on the industry if you're in tech versus if you're looking at utility companies like electric companies or coal companies or gas companies compared to, you know, Apple and Google and Netflix, you're gonna see different price earnings to growth ratios all across the board. So it really is dependent on the industry that you are looking at. But write this one down as well. Some people call it the PEG ratio. Price growth ratio is going to be a very important one to look at. And you can learn more about that if you read some books. Hopefully we're just kind of getting the gist of this to you here. But generally speaking, yes, lower is going to be better. But if it's too low or too high, that could also be some red flags in there. Okay, let's talk about the quick ratio. This is a great way to look at the liquidity of a company basically. This company's ability to pay its debts, pay its bills. This is going to be extremely important. Sometimes companies, they might be, you know, making money, they might be growing really fast, but maybe they're not able to cover all of their bills. Maybe they don't have enough cash flowing in. And so this quick ratio helps us understand their liquidity, which is basically, you know, how much money can they come up with and for how long could they last if they cut off their revenue. And so a higher quick ratio is going to show that they have better liquidity and a lower quick ratio is going to show that they might have a little bit more difficulty paying off their debts. But as always what you're gonna see with a lot of these different ratios, just because a higher ratio might means that they have more liquidity, which is generally seen as a good thing, it could become a problem or a red flag when it gets too high. When you see that this quick ratio is getting really high, it might mean that this company is not using their assets properly, they're not reinvesting back into the business. Maybe they're just sitting on tons of cash and instead of sitting on that cash, maybe they should be taking that cash and pumping it back into research and development or maybe paying dividends or doing something with that cash besides just sitting on it. So you see with a point here where just because there's a higher quick ratio doesn't mean that it's going to be overall like a great thing. There tends to be sort of a balance there on what you want to see with a quick ratio. There's also something known as a current ratio. I didn't make a slide for it because it's pretty similar to quick ratio, but you might see that come up when you are learning more about investing and looking at these ratios that help you to look at the liquidity of a company. It's just current assets minus inventory divided by current liabilities. You can also do the current ratio, which is this current assets divided by liabilities or current liabilities. Okay, so now let's take a look at return on equity. This is a very important thing that we're going to want to look at. So this is a way to measure how profitable a business is in terms of stockholders' equity. Now, the best way to use return on equity is to compare it to other companies that are like it. So if you look at the return on equity of a utility company or General Electric and compare it to Tesla, it will be very different. It will be completely different. So, if you use this, make sure you compare it to other companies that are very similar to it, because that will give you a better idea of how healthy it really is. Unlike if you compare it to the whole market or to, say, apples, oranges, or something totally different. Make sure you're comparing apples to apples and oranges to oranges when you do this. Generally, a higher return on equity is a good thing, but not always, since it can be caused by things like too much debt. They owe a lot of money. This could lead to a return on equity that looks like it's higher, or profits that aren't always the same. Maybe a company doesn't make any money for a long time, and then all of a sudden, it makes a lot of money at once. This could throw off some of this return on equity, especially for quarters, and it could mess up some of the data, so it's not the best measurement, but it's just another one we can use to figure out if this stock is a good one to invest in or not. So, all you have to do is divide net income by the average shareholder's equity to get the answer. Now, if you don't understand some of these terms, I'm sorry. This is something that probably does take a long time to understand and learn, so don't give up on it. A lot of this is stuff I learned in accounting class a long time ago. So, I'm sorry if you feel like I'm moving too quickly, but hopefully you're getting at least the basics. Over the next couple of weeks, you'll learn more about what average shareholders' equity really means. Now, let's talk about the next thing, which is return on assets. Now, return on assets is a lot like return on equity, except that it also takes into account how much debt a company has. This is very important, which is why I like it over. Just the term return on equity makes me think of how you have the P. The second is the price earnings to growth ratio. So there are those that are like the P. And then the upgraded one where you get more information reminds me of return on assets versus return on equity. You're getting more data, more information, and a figure that's a little bit more accurate than the quick and dirty number we came up with for return on equity. Now, this will show how profitable the business is in relation to its total assets. And it's very different depending on the business you're looking at. But in this case, the equation will be net income divided by total assets. So it's not hard to figure out if it's high or low, especially compared to other companies in the same industry. So, if I wanted to buy airline stock in the fall, which I did, I would look at each of these ratios. I looked at return on equity, return on assets, and a quick ratio. I was looking at the current ratio and the price-earnings growth ratio. The price-earnings growth ratio is looking at the P/look at earnings per share, looking at all of those and seeing if they're growing or going down. Let's talk about the ratio of debt to equity. I'm sorry if you feel like I'm throwing too many ratio terms at you, but I want to lay the groundwork so that you can really succeed with investments and be able to talk the talk when we look at this. Okay, so the debt to equity ratio basically shows how much a company is using debt to make money. How does this company pay for its business? How are their workers getting paid? How much money do they bring in? Are they making a lot of money? Can they use that money to pay their employees, pay for research and development, pay their taxes, and pay for everything else, or do they have to borrow it? So the debt to equity ratio is going to be one of my favorite ways to look at a company's health and how much debt it uses to run its business. Now, some companies are going to have higher debt to equity ratios than others. But it's kind of okay because these companies are pretty well known. For example, utility companies that have been around for a long time might have higher debt to equity ratios. Since they have a good credit score, they can borrow money at a low cost. So, their ratios might be higher, but in general, higher ratios mean more risk. This doesn't mean it's a bad thing, but it does mean they're seen as having more risk. If a company is up to its neck in debt or has a lot of debt, this could be a problem, especially if their sales start to drop and they still have to make interest payments. This could be a big red flag and a big problem, and a lower debt to equity ratio is seen as having less risk overall. This equation is just the total debts divided by the total equity of the shareholders. So, figuring out the debt to equity ratio is a pretty easy thing to do. Now, let's look at free cash flow. So, what we're doing here is looking at how much cash is left over after all cash outflows are taken into account. We're going to calculate this or look at the free cash flow because it shows how well this company can pay for other expenses. For example, they might be able to pay off their debts, get out of debt, pay dividends, offer higher dividends if they have more free cash flow, pay off interest, and pay for a variety of other expenses that might come up. So if a company has more free cash flow, that can be a big plus. So, the way we're going to figure this out might look a little strange. We're going to start with the cash flow from operating activities, add interest expenses, and subtract tax shields on interest expenses. The next thing we see is CapEx, which stands for capital expenditures. Right now, you don't need to worry too much about that. Maybe you can learn more about free cash flow later, because this might be a little hard to understand right now. That's okay, though, because we'll figure it out in time, and this is going to be a big one. Just write that down, and you can find out more about it later. Now, let's talk about the ratio of price to book. That would be written as P/B. So, we're comparing the market cap of a company to its book value. So, a simple way to figure this out is to divide the market price per share by the book value per share, also called book value. It will mostly just be the company's net assets. And according to what a lot of value investors say, they like to see a price-to-book ratio of less than 1, even though, to be honest, it's kind of hard to find something like that on the market today, with how many companies are currently valued. And, you know, stock prices are kind of high right now because we've been in a bull run for a long time. It seems like we've been in a bull run since 2009. We had a small crash in 2020, but stocks have mostly gone up a lot since then, so try to find a price-to-book ratio of less than 1. But these days, a lot of value investors are still fine with something in the range or even the 3 range. But generally speaking, we like to see that price-to-book ratio on the lower end. And if you wanted to figure out the book value of each share, you would divide the total assets minus the total liabilities by the total number of shares in circulation. This is the price-to-book ratio. Make sure to write down at least the formula for this one as well. Most of these ratios can be found online, so you don't have to calculate them yourself, but it's good to know how to do so. Let's move on to dividends. I see a lot of dividend investors and people who are interested in dividends. Let's talk about what a dividend is, how to get it, and what we think about dividends that companies offer for their stock. So, a dividend is a direct cash payment from a company to its shareholders, and it's almost like a cherry on top. So, if you have money in Apple right now, the company might pay you a very small dividend. And this is usually based on each share. They'll give you a certain amount of money per share every quarter, sometimes every year, and sometimes every month. It really depends on when this dividend payout structure is, but they will give you a very small amount of money for each share of that stock that you own. It's almost like a reward, or a way of saying thank you. And it's a way for the company to use the money it's making. At the end of the quarter and the end of the year, when they have all the money they've made, they decide what to do with it. Should we put this money back to work? Should we put it back into research or give it to our shareholders as a dividend? So, some companies choose to give dividends to the people who own shares in them. There are pros and cons to this. One pro is that if a company pays you a dividend, which can sometimes be 2%, 3%, or 4%, we've seen dividends on stocks as high as 10% per year, which sounds great. But there are pros and cons to this. On the plus side, you can make money. You can get cash payments or dividend reinvestment from these stocks from these companies. For example, older companies like Coca-Cola or Pepsi might pay dividends that average about 3 to 4%. But this has a downside in that a company looks at its money and the money it's making and decides that instead of putting this money back into the company, it's better to just pay dividends and give people small amounts of money. So I guess I'm kind of stuck with this. I have to be honest and say that I don't know if investing just for dividends is a good financial move over the long term. This is because it could hurt a company's growth if they never reinvest in their business and only pay out dividends, which means they're always giving away all their profit to their shareholders. Could be a little bit of a problem. So you can see how those things kind of go together. which is why it's both good and bad. I would just think of these cash payment dividends as a little extra, or a bonus if I could get it. I do want to warn you about a few possible problems, one of which is called a dividend trap. So, let's talk about common stock market traps on the next slide. Now, I think a dividend trap was the first big trap I fell into when I first started investing. This is why I think it's smart to start very slowly in the stock market, because if you jump into the stock market too quickly and put your life savings into something, you might fall into one of these common stock market traps. We could have added a lot more to this list, but I only chose to talk about a couple of them in this video. One of the first ones I fell into was a dividend trap. Where I was looking at dividends of stocks, I would find stocks with dividends that paid annual yields of 10% or 15%. The problem is that the dividends could not be paid out forever because they were too high for the stock to be able to pay out. So that was one of the first times I got caught in a stock market trap. If you see a stock with a dividend that looks really, really high, you should be careful and a little bit worried. It's probably high for a reason, and it could be a dividend trap. So, when I invest in a stock, if the dividend is more than 6% or 7% per year, that's a big red flag for me, and I'll ask, why? Why doesn't the company cut its dividend? They should be saving money, because that could be a lot of money if they're not growing quickly. But if the dividend is too high, it would just be confusing and raise a lot of red flags, so don't fall into that trap. That was one of the first companies I put money into. Some of them worked out, but a lot of them failed because I didn't know what I was doing. Also, relying only on the stock's price history is a common mistake. I'll show you a great example. Look at Carnival Cruises, Caribbean Cruise, Royal Caribbean, Norwegian, or any other cruise line. If you just look at the stock price and say, okay, the stock price is at $80 right now, but before the pandemic last year, it was at $120, don't do that. If you only look at the stock price, you might miss things like the company issuing more shares. And the stock couldn't reflect that. I can't remember which company it was, but one of the cruise lines, and, to be honest, I think most of them, are selling bonds to raise money. They sold bonds with interest rates of about 15%. So they're paying interest rates of about 15%, and they did all of this, but it might not show up in the price of their stock. So just because the price of a stock is lower than it used to be doesn't mean that it's a better deal overall. So, please don't think too much about just looking at that chart of stock prices. If you look at the charts, you might also fall into the cognitive bias trap, right? If everyone around you is telling you to invest in the stock, that is a very common trap. Look at Tesla, hey, I have Tesla stock. But if you look around, you'll see that everyone agrees that Tesla is going to the moon. Tesla is going to be the next trillion-dollar company. It's going to be a huge business. But look, if you're looking at a company like Tesla, you have to understand that everything has risks. People might think that Tesla is going to be a $10 or $20 trillion company because of cognitive bias. But you have to ask about things that could go wrong. For example, what if, God forbid, what if Elon Musk? If something bad happens to him, he will no longer be the CEO of Tesla. Elon Musk is kind of Tesla's face, so the price of the stock is going to drop very, very quickly. So you can see that cognitive bias is one of the problems, but so is putting too much money into one stock. Watch out for that. If all of your money is in one company, like Enron in the 1990s, I think it's a good idea to spread it out. If you know about Enron, you know that they went bankrupt, had a lot of problems, and were involved in a huge scandal. If you were an Enron employee or you were just so bullish on Enron, that's all the stock that you had was in that one company. And the business goes out of business. Imagine putting all your money in Lehman Brothers or Bear Stearns during the last financial crisis, or putting all your money in Papa John's Pizza in 2017 and then there was a big scandal, right? Things happen, so make sure you have a variety of investments, at least, to some degree. In terms of individual stocks, I like to hold anywhere between 10 and 20 individual stocks, not too many. Because then I won't be able to keep track of all of them, but I won't be able to keep track of too few either. So much so that I can't sleep at night because I know that if one company gets caught with their pants down or has a lot of problems, I could also have a lot of problems. So, find the right amount of diversity. And then one more. The trap here is to make sure you're looking at the competitive advantage or moat of this company. What does this business offer? That's hard for other companies to copy. And if they have a moat, you will definitely benefit from investing in that company. If they have patents, trademarks, or other forms of intellectual or physical property that are worth a lot of money and will be hard for other companies to copy, this can be a good thing. Think about a company like Walmart. What is the company's competitive advantage, or moat? Well, they have quite a few things going for them. One is that they are already very well known. But because so many people are buying it, they can keep the prices so low. So they have a lot of advantages and moats all over the board in terms of competition. We've been talking a lot about Tesla, so let's take a look at what makes them stand out. With their car and technology, they are really way ahead of the curve. But they also have superchargers in every state. Ford, General Motors, and Toyota are the only ones who make cars. They don't have as many places to charge as Tesla does. This is a serious moat, and it's one of the reasons why they are so far ahead of everyone else in the electric car space. I mean, there are Tesla superchargers in almost every part of the country, especially on some of the big roads, like between 80 and 70, and a lot of the big roads have these chargers all over the place. Tesla has a great moat, and it's very hard for other companies to catch up with something like that. So pay attention to those ways and those advantages over the competition. This makes it hard for other businesses to keep up. Let's talk now about how much you should put in. I can't help you with this question, as you can see. I can't tell you that you should put, say, 82% of your money in the stock market. I can't tell you where to put your money, though. But if you want to know how much you should put in, here's what I think you should do. I would suggest starting with something that you are willing to lose, that you can part with, and that you are sure you don't need, especially in the short term. The stock market can change a lot, and if you're trying to invest and you need to quadruple your money by next week so you can pay your rent, you might not be able to do that. Don't do it. Just forget everything you've seen here, because if you're trying to make extra money quickly by putting your money in a slot machine, you shouldn't be here. This might not be the best thing to do. But how much did you put in? Did you start with money you could lose? I had $50 to start with. If that sounds good to you, I would also start with something like that. As I said before, there are two ways to learn: through information like this, watching things or reading books, and through experience. And it's hard to put a price on what you've learned. It takes time, and you'll make mistakes. You're going to make bad investments. Hopefully, you'll also make some good ones, but you're going to make mistakes. You're going to make mistakes. I've made a lot of mistakes, especially in the beginning. I'm so glad I didn't have a lot of money when I started, because if I had, I would have lost a lot of it. So begin small, with $50. Start with $100 or $1,000, if you can. I don't know what your financial situation is, but if you have a lot of money, please go talk to a financial advisor. They can help you much more than I can. An unimportant guy on YouTube. But if you have a lot of money, talk to a financial advisor or start small. Start with a small amount of your money and maybe do it every month, learning more as you go. This will help you get better at it over time. You should put that much money into it. I can't tell you for sure, but I'd start with less than $1,000 right now. Let's talk about bull market versus bear market. What's different about these two? The way I learned this is kind of a dumb way to learn something. But a bull market makes me think of a boy running forward and going up. So, a bull market is when the stock market goes up over a number of quarters. A bear market is when the stock market goes down. Like I said, this is kind of a silly, stupid way to learn something. But I was told that a bear market is kind of like a bear coming down and attacking someone. A bear market is going down, while a bull market is going up, so if the markets keep going down and down for several quarters, that would be a bear market. I would recommend learning about the many bear markets and bull markets that have happened over the past 100 years. And you can read about how each of those happened. It can be a very complicated situation at times. There are times when interest rates are going up too quickly. Sometimes there are big problems with banks, like in 2008, when a lot of them almost went bankrupt and governments all over the world had to bail them out because the banks had too much debt, were getting greedy, and were making some really bad decisions. So, that's what caused the last financial crisis, the one we had here because of the pandemic. What caused that short-lived bear market? right? So with each of these, you'll be able to look at a bull market or a bear market and get a better idea of what caused it. We were in a bull market from, I think, 2009 until 2020, which may have been the longest bull run in history. If not, it would have been the second biggest bull run ever. Most of the time, they don't last that long. It's very hard to know when a bull market or a bear market will start. But it's clear that most investors want a bull market, unless they are short selling, in which case they might want a bear market. We'll talk more about short selling in a moment. Let's talk about market order types. Here are the different kinds of orders you can make. I also have a video about this. So, if you want to see a full video talking about these types of market orders, I will link to that video. The first order is called a market order, and it's a simple one. So, if I want to buy a stock, I can say, I want to buy 100 shares of this stock at whatever the current price is. The price can change a lot depending on who's selling and how much they're selling. So, this is bidding, which is kind of like going to a market and trying to buy something while other people are also trying to buy it. Because of this, the price can change a lot. You're putting in a market order for X amount of shares and you say, I don't care what the price is of just buying it at whatever the current market price is today. That's a market order is the most common. I would say that probably 70% of orders placed on the stock market are probably market orders. And then we have limit orders. You can place a limit order if you want to buy or sell something at a certain price. For example, if you want to buy a stock when it hits a certain price, say $10, you can do that. You can also do the same thing on the other side. If you want to sell a stock when it reaches a certain price, you can use limit orders or stop orders, which are very similar. On the other hand, if you want to learn about those, I think you should just watch the video I made about it, since it's hard to explain on a blank slide. I probably have a couple more slides for this, and there are also stop-loss orders and trailing stop-loss orders. So, if you want to set up a trailing stop-loss order, it can just follow your stock. For example, if the price of your stock keeps going up, the trailing stop-loss order can keep up with it. Then, if the price drops below a certain point, the trade can be made automatically without you having to be there. So you could be doing something like going to the bathroom or picking your nose when one of these stop-loss orders, stop orders, or limit orders goes into effect. It can get triggered at any given moment when that stock price hits a certain point that you set within your brokerage account, and then it can be executed without you even having to be there. You could be out in the woods somewhere without any Wi-Fi. And this might work. I like to use things like stop-loss orders, so that I don't have to worry about some of my stocks going to zero if I go camping for a week and don't have access to the internet. I set trailing orders, stop-loss orders, and stop orders in general so that my stocks can sell automatically if they start to drop too quickly. And I don't have to worry too much about losing all of my money. So that's why we use a few different kinds of market orders. Again, if you want to learn more about market order types, you can watch the video I'll link to below. Now, let's talk about short selling. Tell us a bit about it. A lot of people have asked us about short selling. I also have a video about this that will explain it better. I'll put a link to it in the description below. This is probably covered in a 10-minute video, but here are the 4 basic steps of short selling. You might have heard of GameStop, right? The short squeeze. Back in January of 2021, there was a big short squeeze that happened because of short selling. In essence, you are betting against a stock. You think a stock will go down. If you think a stock will go up, you can buy the stock or shares of the stock, but if you think it will go down, how can you make money from that? There is always a way, and the term for it is short selling. So it can be quite risky. It can be quite dangerous. So it's likely not a good idea to do it right away. But I've done it a few times, and sometimes it's worked out and sometimes it hasn't. Step 1 is to borrow some shares of a stock. So let's say I think Walmart's stock is going to go down, I think it's going to go down, and I think Amazon or Target is going to beat them. Who can say? Let's say, I think Walmart's stock will go down. So what I can do is ask someone to lend me some Walmart stock. Let's say I borrow 100 shares of Walmart stock from a friend and then sell those shares. So, I borrow shares and then sell them, but I don't really own them. This sounds very strange, doesn't it? You'll see how this all fits together when I go sell these shares of stock that I borrowed. Then I wait for the price of the stock to go down. When it does, I buy those shares again, hopefully at a lower price. Then I gave those shares back to the person who had just lent them to me. I hope that all makes sense. In a nutshell, that's how short selling works. But quickly read over these 4 steps. I'm borrowing shares of a stock and then selling them to someone else, right? Then I buy those shares back at a lower price and give them back to the person from whom I borrowed them. When I give those shares back to the person I just borrowed them from, which could be a week or a month, depending on how long it takes, I'll give them a little bit of interest on top, which is why they lent me their shares in the first place. So, this is how selling short works. In a very basic way, that's how it works. But I hope that helps you understand how it works, and you can probably do this through your brokerage account. I know that short selling is possible with most brokerage accounts, but you should be careful with naked short selling. People can end up in a short squeeze where they lose a lot of money with Melvin Capital and GameStop. You should look it up on Wikipedia because it was completely crazy for a few weeks in January 2021. I barely slept. So, that was kind of cool. But that is called selling short. Now, let's talk quickly about taxes on investments. In America, there will be 2 main kinds of taxes. Keep in mind that this is for the US and that I'm not an accountant. I'm not a CPA, so please talk to your tax expert. I'm not an expert on taxes. I just have to say that, I think. So, we have investments that pay off quickly. If you've had your stock for less than a year and then decide to sell it, you might have to pay these rates. So you can see that the federal tax you pay could be anywhere from 10% to 37%. You'll probably also have to pay taxes at the state and local levels. This is for the United States, of course. If you live in Europe, I don't know what your tax brackets will be like, they could be higher or lower. This is for investments that will be held for less than a year. So, if you buy a stock and sell it after a month, a day, or 3 months, you will lose money. That's a short-term investment. You pay taxes on it at your regular tax rate, the same rate you pay on any other income you might have. Long-term investments are different. This is called long-term capital gains tax, and I think it was really put in place around the time of the dot-com bubble. This is one of the reasons why the dot-com bubble happened, since it brought in a lot of VC money. That's not what this is about. Let's talk about investing for the long term. If you have stocks or other assets for more than a year, you may have to pay taxes at these rates. 0%. If you make between $0 and $40,000 a year, that's pretty good. 15%. If you have long-term capital gains of $441,450 or more, you will be taxed at a rate of 20%. If you have between $441,450 and $471,451, you will be taxed at the same rate. This is again a federal issue, so you probably won't have to pay state taxes. I know that Pennsylvania takes out an extra 3.07%, and on top of that, I might have to pay a local tax. If you live in California, you might have to pay 13.3% more. So, the tax rates are as follows. I really like tax law. I think you should read some books on taxes. It's cool. Maybe I'm weird. I don't know if you like taxes too, but if you do, join my tax club. I don't have one yet, but it would be fun to start one. Now let's talk about the best books on investing. So here are a couple. I've given away most of my books because I like to live a simple life. So, I used to have a lot of books about investing, including one of the best ones, which I would definitely recommend reading. It's called The Smart Investor Plan. It's great for looking at the big picture. It's a great way to invest in value if you're kind of like Warren Buffett. Benjamin Graham wrote it. He taught Warren Buffett, who has been one of the richest people in the world for a long time. He used to be the richest person in the world, and he probably has close to $100 billion right now. He also gives away a lot of his money. But he keeps doing more and more crazy things. This is a great book, and the intelligent investor thinks you should read it. There is also a book called Security Analysis that you can read. This one is more like a textbook, so people who don't like to read will probably find it very boring. So I wouldn't recommend it to people who don't like to read, but if you're a bookworm, like me, you might like it. I like to read textbooks, and this one has more of a textbook feel to it. It's a big book, I don't have it with me, but it's huge, and I think it's also a little bit more expensive. You might pay close to $60 for Security Analysis, but I would also recommend it. But, to be honest, I love these for dummies books. They are great books, even though people always talk bad about them. I'm not sure why I like these so much. When I start talking about a subject, this big one is Investing for Dummies. If you read this whole thing, you will be so ready to start investing. And just to understand the language in general, you can find all the different financial ratios in here. So, this is a simple book for beginners, and it cost $29.99. So not bad. Something like this wouldn't make me feel bad. They also have different versions, like one for technical analysis, and one for fundamental analysis, which I also recommend. A Random Walk Down Wall Street is another one of my favorite books about investing. It was written by Burt Malkiel, who is an amazing economist. In this book, he argues that the markets are almost random and that a monkey could throw darts at a dartboard and do just as well with stocks as a person who has spent 30 years in the markets. So that's what he thinks. And he makes that point very clear. It's a very interesting book to read. I would recommend that you read A Random Walk Down Wall Street, but I just finished a book called One Up on Wall Street, which is another great book that I think everyone should read and about which you can learn more. I really think you should read some books, like books on accounting, so you can understand the financial statements a lot better. But those are some of the best books that I think you should read. Okay, so we've talked about a lot of things in this video. I really hope that this has helped you a lot and that you've learned something new today. But let's talk about what we should do next. If you want to start investing in the stock market, let me give you a quick plan of what I think you should do. And I would start with a very, very small amount of money, like $100, $200, or $200, whatever you can afford. But something small, because the truth is that you might lose it. You could make a lot of money, but you could also lose it. So, start with a small amount of money and read one book a month. Choose an item from a long list. Just type best investing books into Google and you'll find some great ones. But pick one book a month and read it. After 6 months of getting your feet wet, you could put a couple $100 a month into the stock market and learn a lot from the free books at your local library. I really think that you can have a good chance of succeeding. This is not a promise, of course. This is not I'm sure I've seen people lose money on the stock market. Don't act like it's a casino. It's something you can sell for money. But you have to be very careful about how you deal with it, and use your head instead of your heart. So, I'll leave some links to the resources and stockbrokers that I recommend below. Keep in mind that some of these links are affiliate links. So it means that if you sign up with some of these brokerage companies, I might get a small amount of money or a commission. This just helps me keep my videos free so you don't have to click on those links. But if you're going to sign up for one of those accounts, it would mean a lot to me if you used one of those links, especially if this video helped you in some way. Thank you for watching. I really hope the best for you. Go ahead.